U.S. stocks are flirting with record highs, leaving many wondering just how much more fuel is left in the rally. But Ann Sonders, the chief investment strategist at Schwab, says that skepticism might propel stocks even further. And Ann joins me now on set. Ann, it's nice to see you. Welcome back.
Thanks for having me, Scott.
So explain this dynamic here. You think we'll keep seeing record highs in stocks?
So I think in the short term, the market does have some overbought technical conditions right now, and I'd be careful about getting too greedy in an environment like this. But one of the reasons why we have remained fairly constructive this entire bull market is because of how many disbelievers there are. I think the sentiment environment is really probably the most important prop for the market. And in fact, I think was one of the preconditions for the rally that we have had. I think that sentiment got so washed out after the Brexit vote. You saw post-crash of 87 like levels of bullishness and heights of uncertainty. And I think that was really the setup for the rally that we have gotten. But I think longer term, it's also a pillar. No one has been a big believer in this bull market, and that's a positive.
Well, and there are also some really tangible reasons why the markets are higher. Economic data has been a lot stronger. Let's take a look at this chart, which shows the Citigroup U.S. Economic Surprise Index versus the S&P 500. Those two lines, you see the yellow line is the S&P 500, the blue line is the Citigroup Index. Those two lines have been moving in lockstep, and look at the past week or two, both lines have been moving sharply higher. So, I mean, this is a good sign.
And the Economic Surprise Index measures whether data is coming in better or worse than expectations. It's not a measure of absolute growth, and I think what's confounding to a lot of people is that the economy isn't strong, but the fact that we've seen better economic data. One of my mantras that I say all the time is better or worse matters more for markets than good or bad. So it's that inflection point. It's that turn, the improvement, that's sometimes all you need for a launch for the stock market. Typically, at the point where all the economic data is great again, you've already missed most, if not all, the move in the market.
All right, so the big question now is, how does the Federal Reserve process all this in its meeting on Wednesday?
So I think the Fed doesn't do anything. There's no press conference associated with the meeting, but there is a statement. And I think I would look for some nuances in the statement that suggests that September is on the table. We do think September is on the table if the data continues to come out better than expectations. If they wait until after the election, they do in December, but we're pretty convinced that in their mind is the idea that raising rates at least one more time this year is the right decision.
Okay, so one rate hike this year, not two.
I think if they move in September and the data continues to ramp, then I think December could be on the table as well.
All right, and you're also neutral on stocks, so what are you telling clients?
So neutral means we recommend our clients stay at their long-term normal strategic allocation to equity. So it's not by any means a bearish position.
Sure.
And use volatility to rebalance around that norm.
Okay, and one thing we did not talk about, of course, is the bond market. So we're seeing yields on not only the U.S. Treasury, but global sovereign debt, coming down. In Europe and Japan, it's either near zero or in negative territory. How do you have a rally in the bond market and a rally in the stock market at the same time?
Because I think a lot of the forces that are pushing down global bond yields and even yields here in the United States have less to do with sort of an economic Armageddon scenario and more to do with massive central bank buying, safe haven buying on the part of investors, that hunt for yield, which makes even a relatively low Treasury yield in the United States, being that it's positive, attractive. So I think those are the forces that are conspiring to keep bond yields low, keep bond prices high, but those conditions don't necessarily mean problems for the stock market because the economy is improving. So that's why you have this cohabitating relationship right now in terms of bond prices and stock prices.
All right, well, all issues we'll be watching. Ann Sonders, thank you so much for coming back.
Thanks, Scott.
I'm Scott Gam, and you're watching The Street.